All right, let's get right into this explainer. We're looking at what we're calling the Great Market Exit. Right now, if you look around, the most valuable companies on Earth are practically racing to sell you their stock. You read the news, and the headlines around these recent tech IPOs are just celebratory. It's wild because for decades, the best companies stayed private. They grew in the dark, totally out of reach for regular folks. But today, it feels like the biggest tech boom in history is finally throwing its doors wide open for us. But what if I told you that every open door in the stock market might actually be a trap? Seriously, in finance, generosity is never just out of the goodness of someone's heart. Every single trade needs a counterparty. If you're buying, someone, somewhere, is making the conscious choice to sell to you.
And honestly, that brings us to the central mystery of this whole explainer. When we talk about an initial public offering, the people on the other side of your trade aren't random. They're the founders who built the companies, the early employees, the venture capitalists who wrote the checks when it was just a sketch on a napkin. These guys have seen the internal metrics that you and I will literally never get access to. So here's the million-dollar question. If the future of these companies is truly as bright as everyone keeps promising, why are the smartest founders suddenly so eager to share their wealth with you? Why do they want your cash more than they want their own shares?
Let's dive right into Section 1, the open door trap. To really get this trap, we've got to strip away all the Wall Street confetti and ringing bells. When you look past the hype, an IPO is fundamentally a trade defined by information asymmetry. Basically, this is a transaction where one side has a massive knowledge advantage. The sellers are hands down the absolute most informed people in the room. They know the real profit margins, the user retention, the looming threats. Which means you, the buyer from the public, are by definition the least informed person in the room. You're buying a narrative while they're cashing out based on hard data.
All right, moving on to Section 2, History's Market Tells. Just like in poker where a player might have a subtle tell that gives away their hand, markets have tells too. And the clearest tell is watching what professionals actually do with their money, not what they're saying on TV. Retail investors usually sell when they get scared, right? When the chart drops. But the pros, they do the exact opposite. Benjamin Graham, the father of value investing and Warren Buffett's mentor, hit the nail on the head. He said, "The intelligent investor is a realist who sells to optimists and buys from pessimists." The pros are realists. They sell when everything looks absolutely perfect. They sell when the story is deafeningly loud, when optimism is at its absolute peak, and there's a literal line of buyers begging to get in. Because that is the exact moment you can squeeze the maximum amount of money out of whatever you're selling.
Let's look at a prime historical example of this. Rewind to June of 2007. Wall Street was booming, right? The founders of Blackstone took their company public, and they gracefully walked away with about $2.6 billion in cash. Then, just a little over a year later, bam, the 2008 global financial crisis hits. The market crashes, and Blackstone stock plummets roughly 90%. Talk about perfect timing. It was a flawless exit by insiders right before the floor completely fell out.
And the exact same tell played out on a massive scale during the dot-com bubble. Look at 1999. IPO concentration hit an all-time record. 51% of all new public companies were from one single sector, tech. Insiders were getting incredibly rich, while retail investors thought, hey, I'm buying the digital future. Then the bubble popped. Over the next 2.5 years, the NASDAQ crashed more than 75%. $5 trillion just evaporated into thin air. And get this, according to a Kauffman Foundation study, 10 years later, only 29% of those emerging growth companies were even still standing. So yeah, when insiders sell into a frenzy, it's usually catastrophic for the retail buyers left holding the bag.
So that brings us to Section 3, the SPAC illusion. Now, if you think this is all just ancient history, think again. This same pattern repeats itself today. It just likes to wear different costumes. In 2021, that costume was called a SPAC, or Special Purpose Acquisition Company. Essentially, it's just an empty shell company with a massive checkbook. It goes public first, raises a ton of money from regular folks, and then goes shopping for a real business to merge with later. The real appeal? Well, it was basically a disguised backdoor for private companies to skip the heavy scrutiny, the rigorous vetting, and the long waiting periods of a traditional IPO. And the amount of money that rushed into this loophole was just staggering. It created this violent spike and collapse. Look at this. We went from 248 SPACs in 2020 to a massive 613 in 2021. They raised over $160 billion in a single year. And then, once the insiders got their liquidity, the music stopped.
By 2022, the whole thing collapsed down to just 86 SPACs. The classic dine and dash was complete. So who actually paid the bill for that dine and dash? You guessed it, the average investor. The data shows that once the rug was pulled, companies that completed a SPAC merger in 2021 lost an average of 67% of their value. For the ones that merged in 2022, the average loss was 59%. The public was sold a shiny story, while the insiders cashed out right at the top.
Okay, let's get into the real meat of this explainer in Section 4, the AI spending gap. Right now, there is a brand new story being sold to the public. This year, big tech companies are on track to spend a mind-bending $725 billion building out AI infrastructure. To make that number feel real, the source provided an absolutely wild analogy. Imagine starting at the year zero, the birth of Jesus, and spending $1 million every single day. You just keep dropping $1 million a day through the fall of the Roman Empire, through the Renaissance, both world wars, all the way up to today. Even after all of that time, you still would not have spent what big tech alone plans to spend on AI in just the year 2026. It is literally the fastest and largest infrastructure build-out in human history. But hey, spending money is only half the equation in business, right? Here's the reality check. On one side, we have that $725 billion in planned spending. On the other side, research firm Exponential View estimates the entire AI economy combined generated just $110 billion in revenue over the past 12 months. And that's not profit, folks. That's just revenue. The entire industry earned back roughly 15% of what just the top companies plan to spend this year alone. That gap is just staggering. So the vital question here is, are the businesses buying all this AI tech actually making money with it? Well, the answer is pretty bleak. A recent study by researchers at MIT looked at hundreds of real corporate AI rollouts. They found that 95% of them produced zero measurable return for the businesses using them. Zero. The money is pouring in, but the returns simply aren't materializing yet. This is creating a massive disconnect from the fundamentals. Take OpenAI, for example. They're sitting right at the center of this storm. Based on leaked financials, they're bringing in about $13 billion in revenue. But their net loss? $38.5 billion. Their own internal estimates show they expect to burn well over $100 billion by 2029. Yet, despite these brutal cash burns, their recent valuation priced them at $852 billion. That is over 65 times their revenue. The price has just sprinted miles and miles ahead of the actual reality of the business. Which brings us to our final part, Section 5, Reading the Room. So, how does all this data actually translate into the psychological reality of the stock market? Like, why do the players keep playing if they know the numbers are this stretched? To get that, we have to look at one of the most infamous quotes in finance history. In the summer of 2007, just months before the financial system nearly collapsed, Citigroup CEO Charles Prince said, "When the music stops, things will be complicated. But as long as the music is playing, you've got to get up and dance." See, he wasn't saying the party would last forever. He knew it wouldn't. He was admitting that Wall Street is essentially a giant game of hot potato. As long as the money is flowing, you keep passing the risk to the next eager buyer, and you just pray you aren't the one holding the potato when the music cuts out. And that perfectly sums up the rational exit strategy we are seeing right now. These insiders aren't dumb. They see that prices have completely decoupled from fundamentals. They know the AI arms race is going to require impossibly deep pockets to sustain. So what's the logical move? Smart money sells to the hungry, optimistic crowd right now, while the story is pitch perfect. They know the fundamentals will eventually catch up, even if predicting the exact date of a market crash is completely impossible. Look, you don't need a magic stopwatch to predict a crash. You just need to be able to read the room. You have to look past the hype, look at the historical tells, and ask yourself what the smartest people in the room are actually doing with their cash. So I'll leave you with this to chew on. When the music finally stops in this current market cycle, are you going to be the last one left on the dance floor?